Hello and welcome to my morning note. Risk is back off again today. It was only back on again for one more day, and the reason for that is obvious enough. People are worried yet again about the political situation in Europe. But perhaps rather than obsessing about the potential for what could happen in Europe, it might be worth taking a look at what's already happening, at the effect that the great macroeconomic, the political concerns are having on the ground. And that's perhaps most obvious in banking and the money markets, where the steady financial integration of Europe that we've seen over the last few years may be coming apart. You might even be able to talk about the financial disintegration of Europe. That, at least as I understand it, is the direction the reporting of my guest today is taking. She's our US managing editor, Gillian Tett. Gillian, thanks for being here today. Let's take a look first of all at familiarly gloomy chart showing the state of the European banking system at the moment. The stock is obviously doing very poorly, and the credit is coming under stress again. Does that chime with you've been talking to people who are very close to this situation? Does that make sense to you?
Absolutely. I mean, the reality is that right now the mood inside banks is pretty nervous, but there's also a much longer term concern, which is not simply how is Eurozone going to perform, is the Eurozone going to break up? It's also how on earth are we going to create a business model that actually works?
Right. Now, there was a suggestion only a few weeks ago that the ECB had saved the day with the LTROs. If we take a look at our second chart, this is borrowed from the ECB lending survey, you can see that we appear to be on our way to a genuine credit crunch that then abated in the last few months. Is that merely a temporary response to a big dose of cheap money then? Is that
the ECB averted the panic? That's good news. They put a sticking plaster, a band-aid over the wound. The problem is there are two challenges going forward. Firstly, European banks need to deleverage in general sense. The European Central Bank and the IMF have pointed that out before. But secondly, as people start speculating about a possible breakup of the Eurozone in theory, in practice, the way that banks are running their operations, both American banks and Eurozone banks, already points to fracture, in the sense that increasingly banks are conducting what are called ALM operations, asset liability matching operations, which essentially start treating the Eurozone countries as single countries, not part of a single Eurozone.
Okay, so you're saying we're already beginning to lose the benefits of having such a large financial bloc. The fact that they all have the same currency is no longer relevant. Does that mean it's harder for a Spanish company or a Portuguese company or whatever to actually raise financing at this moment?
Think about, say, a German or French bank that's got loans to Spain. In the past, they would have covered those loans, that risk, with deposits from anywhere else in the Eurozone or with money market funds. Today, however, the problem is they can't raise money in the wholesale markets, and they're no longer willing to cover a Spanish loan with deposits, say, in Finland, because of the concern that the Eurozone system may not continue to hang together. So they want to match their loans in Spain with deposits in Spain. And the problem is there simply are not enough deposits at a reasonable price to go around. So, of course, they're cutting back, and that just adds to the squeeze that's going on.
Okay, now this sounds like a process that isn't easily reversed. We're talking about fairly deep textured banking practices here. I mean, even if Brexit is averted, even if somehow or other Europe muddles through, which is still a very real possibility, it sounds as though we're going to have a patchier, more balkanised banking system for a while. Is that a fair
Certainly
statement?
at the moment the system is becoming a lot more balkanised. It's fantastically hard to track this because banks are very secretive. But in theory, if banks began to believe completely that the Eurozone was being reconstituted on a stronger footing and had faith this would last continuously, then in fact this could be reversed. The problem though is that already banks are balkanising their lending books, and it's not just Eurozone banks, it's US banks as well, and it would take an awful lot to actually reverse that tide. The great irony, as the ECB has pointed out itself, is that the Eurozone project was actually launched to try and create more integration across the Eurozone. The tragedy right now is that disintegration may already be occurring, and with that many of the benefits are being lost.
Okay, Gillian, thank you very much indeed. Even though that wasn't exactly a positive outlook, it shows how important it is to look below the headline numbers. We'll enjoy Gillian's column on this subject in the days that come. For the most important takeaway for the time being is that there is a serious shortage of positive outcomes that can come from the Eurozone debacle.